Markets staging a Halloween rally this morning. Futures higher on the heels of a surge in U.S. stocks Tuesday, closing the day in the green after another wild session on Wall Street. This morning, we're looking at the market to be up at 90 points right out of the open, 1/3% this morning. The S&P is up 0.5%, and the Nasdaq is up almost 1%. This boost following mixed third-quarter earnings from Facebook. The networking giant beat on earnings but fell short on revenue. And then there's the daily users. The daily users bruising the company with slowed growth. We're going to tell you about the users there. We're also watching Apple this morning, set to report tomorrow after the bell, and the revenue expected to be at $61.5 billion on earnings of $278. Joining us right now is Cresset Wealth Advisors Chief Investment Officer Jack Ablin. Jack, it's good to see you again. Thanks so much for joining us.
Hey, nice to see you.
So we got a firmer tone today, but obviously it's been a rough month for the markets, the month of October. What would you be doing at this point? Do you want to put money to work or wait for things to settle down?
Yeah, it depends on your time frame. I think seasonally, midterm elections tend to rally November, December. So, if you want a short-term pop, maybe now's a good time to get in. Longer term, I still think there's some issues that we have to resolve, and that is the central banks ending this extremely easy monetary policy, both here, of course, but also most notably in Europe, where quantitative easing is set to end in December. That's been a big factor, could push interest rates even here higher.
So you're saying that the Fed raising rates is going to be a negative for stocks?
Yeah, the fact is that we've enjoyed massive easy monetary policy for 10 years. And with the ECB set to end their monetary policy, this quantitative easing that will, that will end in December. That stimulus that we've enjoyed is coming to an end.
Sure.
Yeah, that means that interest rates will likely move back to fair value.
Yeah, Jack, you're bringing up a very big point where the easy money is gone, right? Especially in the markets, because we've got the cost of capital going up and we also have the cost of labor going up. And so you need to focus on companies that have pricing power. And I was looking at Morgan Stanley actually has been pretty good at being in front of what this recent sell-off. I mean, they predicted a tech sell-off of 10%. We've gotten it. They recently came out with 32 stocks that they say have robust pricing power. One of them is a cell phone tower company. American Tower reported yesterday. They said everyone's downloading video and they have unlimited plans with their mobile characters or their carriers. So we're going to do very well going forward because we still haven't built out 4G. So where are you looking to place your money? Because it seems like you want to get into sort of the slower infrastructure, safer names in this market.
Yeah, I mean, I think you're right. I would focus not so much on tech, just because you need such a long runway to be able to come up with fair value, and that higher discount rate will tend to crush the prices in that more to the downside. The good news is a lot of it's behind us, I suppose. I would focus on consumer. Consumer is still very strong. Demand's higher, both consumer discretionary, consumer staples, and financials. Financials do tend to benefit when rates rise and the yield curve steepens. That could also set up, fundamentally pretty strong. Emerging markets, if you do think that the wave is behind us, I still think there's a little more turbulence to go. Emerging markets are cheap. I'm just waiting for a little more positive momentum, just little more investor acceptance to say, okay, the coast is clear in the emerging countries. But all in all, I would say probably cheaper entry points as more and more investors recognize that, the 10-year Treasury needs to be closer to 4.5%, not 3.1%.
On a micro level, Facebook, that got a lot of attention. And in terms of what's going on in this market, because we've seen stocks like Amazon and Netflix get so hammered in this environment, Facebook, its revenue came up short of expectations. It did beat on EPS. Revenue and earnings growth did slow. Miss on revenue. disappointing if you read the report, but you see the stock up in pre-market trading because Facebook shares had lost more than a third of their value since July. Since that report in July, it was down 20% year to date. And so you see people, see people willing to react in a positive way to even something that's quite disappointing.
So it was really just a valuation thing. They're bouncing the stock because of the decline.
They did beat down expectations with a stick. I mean, it was the investors were expecting the worst.
Yeah,
which is maybe what Amazon was trying to do in its earnings report. I know that the stock got creamed, but they were really trying to, kind of, as Michael Block said, sandbag the revenue forecast in the holiday quarter. So maybe they're doing that. That's worth noting in terms of Amazon.
What are your thoughts away from the Federal Reserve? I mean, the tariff and the trade issue, Beijing in a bind, China reporting the slowest manufacturing growth in more than 2 years. It's adding to mounting economic fears as it starts to feel the bite from this trade fight. October was the first full month of the latest round of tariffs issued on September 24th, Jack. Are you worried about the tariff situation and its impact on earnings?
Yeah, I mean, it's a 1-2 punch for China. The fact is that President Xi was really embarking in a deleveraging program to begin with. Debt to GDP, financial, non-financial debt in China is something like 260% of GDP. So clearly a lot of that growth that they've enjoyed over the last, several years has been fueled by leverage. So if you add this deleveraging factor, plus the tariffs, that's really pushing China growth to the downside. And, that's really, they're the second largest economy, so that's certainly going to feel its effect in the global economy.
Yeah, Maria, and they're saying that the administration is saying that they're possibly going to put more tariffs on the Chinese goods, and imports in December. And Citibank is saying that will make products potentially 10 times higher at the checkout counter for average Americans. So I think this is staying in the news.
Yeah, well, that's the thing. I mean, if we see these tariffs, additional tariffs come on, that will force companies to raise prices, Jack, and that's going to obviously take up inflation and slow down spending, likely.
It's a reversal of the tailwind we've enjoyed for the last 30-plus years. The fact is that globalization has helped keep prices low, keep innovation high, and inflation at bay. If that pendulum swings the other direction, we could see an environment where the opposite is true.
Yeah,
that's not great for stocks.
Are you expecting a good jobs report? We got the October jobs report on Friday morning. Do you think it's priced in? What kind of the expectations are 190,000 jobs created in the month of October?
Yeah, I mean, I think we should have a decent jobs report. I would like to see a report that's over 200. That's been a trend we've enjoyed in the past. So the fact that expectations are below 200 is, hey, it's a great problem to have, I suppose. But, I would like to see a print that's above 200 if we can pull it off.
Jack, just to be clear, would you put new money to work in the stock market today or not?
No, not yet. I would say, in fact, quite honestly, Maria, I would use the November, December historical rally as probably a way to reduce risk, because I'm starting to see credit conditions tighten. We saw spreads widen. We see Capital One and another credit card company starting to lower their capacity to take on new customers and lower credit limits. So I just do start to see a little tightening of credit, and you add, high valuation, slowing economy, and tightening credit. It's not a great formula for putting new money to work right now.
We'll be watching. Jack, good to see you this morning. Thanks so much.